It is time now for our weekly Muni Moment segment, and that's Taylor Riggs. Taylor.
Hey, Bonnie, and joining me today is Michael Zezas. He's the Chief Municipal Strategist over at Morgan Stanley. Michael, it's great to have you because we've been talking a lot about volatility and some things that are affecting munis. Some could be from a credit perspective, some could be from an interest rate perspective. What are you more worried about at this moment?
Yeah, and thanks for having me on, Taylor. We're definitely more interested in interest rates right now. So we have this saying that munis are a rate market with a credit problem, and that's because the muni market is more or less a rates market. 70% owned by retail, directed by proxy. They tend to react to total returns and volatility driven by interest rates. So in the near term, what's more worrying to us, because I think we've had this moment this year where a lot of outperformance in munis was driven by low volatility and flatter curves, is what if it goes the other way? That's not our view, but certainly we're mining things like Fed statements to see if the Fed's going to let it run a little bit hot. Because if you get a more volatile bear steepener in the yield curve, we think that's the type of thing that could lead to outflows and underperformance.
Now, when we talk about the steepness of the yield curve, you also mentioned that you're duration neutral at this point, but that long duration, you say, should be sort of a home base for munis. Can you walk me through that trade?
Yeah, well, so I think for you're supposed to let bonds be bonds, right? So munis in an asset allocation framework are supposed to give you downside protection. They're supposed to give you carry and calm. They can't do that if you're sitting in cash or cash equivalents, right? So that's point number one. And so you can't get that sort of sitting in the short part of the curve. And frankly, over the long term, that sort of total return feedback loop is going to be positive, and it historically has not been a problem in even the most kind of severe bear steepening moments of the market.
You also talk a lot about sovereign risk.
Yeah.
Some ways that we've learned our lessons the muni market has was from Puerto Rico, that sort of J-factor risk where a judge can come in and sort of overturn things. Are there any other sort of credit things that you're worried about, Illinois not passing a budget or something on the horizon that makes you concerned from a credit perspective?
So it's not the single name story so much at the moment, right? I mean, Puerto Rico is a very obvious single name story. Illinois is an obvious single name story. You know, the question to me is what's systemic, and the idea of sovereign risk in the muni market is the idea that a state issuer is sovereign. When you buy a bond of theirs, you're making an agreement with an entity that has the power to ignore that agreement, right? When you pile that on top of the issues of long-term deferred capital needs, long-term underfunded retirement liabilities, you have a sector of the market that's a lot more cyclical than it was before. We need to kind of price all of that risk more appropriately. That's why we're very much underweight that sector relative to municipal enterprises, for example.
So nothing really on the horizon that keeps you up at night at this point?
From a credit perspective, not at the moment. I mean, you have those single name issues. You need to work around them. I think the appropriate way is by taking that sector and being underweighted versus the benchmark, as opposed to sort of specifically following the headlines around any particular single name issue.
Wonderful. That was Michael Zezas, the Chief Municipal Strategist over at Morgan Stanley.